All right, so looks like we're diving into dividend stocks today.
Yeah?
Specifically, how to get those nice steady returns without needing a ton of cash up front.
Right.
And
Okay.
we've got this great article here from The Motley Fool, published just yesterday, December 18th, 2024,
Yep.
talking about how to get started with only $500. They even highlight 3 companies known as Dividend Kings.
Oh, yeah, dividend kings.
Yeah.
Those are the top tier.
Royalty.
The royalty of dividend payers.
Exactly.
So are you ready to find out which companies are fit for a portfolio king or queen?
I am definitely ready.
Let's do it.
All right, let's dive in.
Dividend kings.
So before we get into these kings, though,
Okay.
can you just remind us why someone would choose dividend stocks in the first place?
Yeah, that's a great question.
Yeah.
I think a lot of people, when they think about investing in stocks, they think about growth.
Yeah.
Share prices skyrocketing.
Hmm.
But dividends offer this level of predictability that growth stocks often lack.
Mm-hmm.
And the Motley Fool article points this out.
Okay.
Dividend stocks provide a regular income stream no matter what the market is doing.
Okay.
It's like this built-in safety net for your portfolio.
So even if the market takes a dip, you're still getting paid.
Exactly.
Okay.
And that makes a lot of sense, especially in today's economy.
That makes a lot of sense.
Right.
But there are tons of dividend-paying companies out there.
Yeah.
What makes these dividend kings so special?
So special. It's their commitment to consistency.
Okay.
To earn the king title, a company has to increase its dividend payments for at least 50 consecutive years.
50 years.
That's half a century
Wow.
of steadily rewarding their shareholders.
That's longer than some companies even exist.
I know, it's incredible.
Yeah, that's a serious vote of confidence for long-term investors.
Absolutely.
Okay, so the Motley Fool chose 3 of these dividend kings to highlight for someone just starting out with $500.
Yeah.
Shall we meet our first royal?
Let's meet royalty. First up, Johnson & Johnson, a company practically everyone knows.
Yep.
And they've actually blown past that 50-year mark with over 60 years of consecutive dividend increases.
Wow, they're overachievers even among royalty.
I know, right?
But what about the actual payout?
Yeah.
What can an investor expect to see in their pocket?
So right now, J&J pays an annual dividend of $4.96 per share,
Okay.
which works out to a yield of about 3.3%.
Right.
To put that in perspective, the average yield for the S&P 500 is only around 1.3%.
That's more than double
More than double.
the average.
Yeah.
Wow, but is that because they're taking on more risk, or are they just that good at what they do?
Well, they're a giant in the healthcare sector,
Okay.
both pharmaceuticals and medical devices.
Oh, wow.
So it's like they've got this whole healthcare market covered.
So a true one-stop shop for, everything health-related.
Pretty much.
Does that give them an edge when it comes to staying profitable and keeping those dividends flowing?
Absolutely. And get this, they recently spun off their consumer health business.
Oh.
Things like Band-Aids, Tylenol,
Oh, yeah.
those everyday things.
So it seems like they're doubling down on what they do best.
Exactly.
Does that make them even more attractive as a dividend stock?
Potentially, it allows them to really focus on their most profitable areas like innovative medicines and medical technology,
Okay.
which are already seeing strong growth.
Mm-hmm.
Some of their key brands are experiencing double-digit revenue growth.
Double-digit growth. I can see why they made the cut for this article.
For sure.
J&J definitely seems to be living up to its royal title.
Yeah,
Ready to move on to contender number 2.
absolutely. Next up, we have Abbott Laboratories, another healthcare powerhouse with over 50 years of consecutive dividend increases under its belt.
Okay, so another solid player in the healthcare space.
Yeah.
How does their dividend compare to J&J?
So Abbott pays a dividend of $2.20 per share,
Okay.
yielding 1.9%.
Right.
It's a bit lower than J&J's yield, but still well above that S&P 500 average.
Yeah.
So, maybe not as flashy as J&J,
Right.
but still a respectable payout.
So maybe not as flashy, but still respectable?
Exactly.
What's Abbott's secret to success? Are they also a one-stop shop for all things healthcare?
They are diversified, but in a different way.
Okay.
They have 4 major business units:
Okay.
medical devices, diagnostics, nutrition, and established pharmaceuticals.
So it's almost like they've got a backup plan for their backup plan.
Exactly.
Yeah.
They're really well diversified,
Yeah.
which is great for,
Interesting.
riding out any kind of economic storms.
Having a hand in so many areas of healthcare must give them some insulation if one part of the market slows down, right?
Exactly. For example, their diagnostics business took a hit recently due to lower demand for COVID tests.
Oh, right.
But their other areas were able to pick up the slack,
Interesting.
demonstrating the power of diversification.
So steady and stable, even with some bumps along the road.
Yeah.
What else is Abbott doing that makes them stand out in the healthcare crowd?
They're venturing into the wellness space,
Okay.
which is a growing market.
Yeah.
They recently launched Lingo, a continuous glucose monitor that you can get without a prescription.
Ah, so they're tapping into that preventative health trend.
Exactly.
It seems like they're constantly looking for ways to stay ahead of the curve.
They are.
All right. 2 dividend kings, down 1 to go.
All right.
Who's our final contender?
This one might surprise you. It's Coca-Cola.
Coca-Cola, really?
You wouldn't think sugary drinks would be the key to a stable dividend,
Right.
but they've got over 60 years of consecutive increases, just like J&J.
Okay, you've definitely got my attention now.
Good.
Coke is about as classic as it gets.
Yeah.
How do their numbers stack up against J&J and Abbott?
So they're paying $1.94 dividend per share right now.
Okay.
For a yield of about 3%.
All right.
So right on par with J&J in terms of yield, even though they're in completely different industries.
I'm impressed. They've been around forever, but they've clearly adapted to changing consumer tastes and kept those dividends flowing. What's their secret? Is it just the global love for Coke?
Well, it's more than just Coke these days. They actually own over 200 brands globally,
200 brands.
including Minute Maid, Dasani, Powerade, you name it.
Wow, so it's about way more than just sugary drinks.
Way more.
Does that kind of diversification help them weather economic storms?
It definitely plays a role. And their massive global reach also provides a buffer against regional economic downturns.
Mm-hmm.
They sell a staggering 2.2 billion servings of their drinks every single day around the world.
2.2 billion.
It's a lot of drinks.
That's insane. It sounds like they've built an empire on beverages.
They have.
And with their track record of dividend increases, those drinks are clearly translating to sweet returns for investors.
Absolutely. Their consistent growth, thanks to their diverse portfolio and global reach, has allowed them to keep those dividends flowing for decades.
All right, so we've got 3 incredible companies,
Yeah,
all dividend kings, and all potential investments for someone with just $500.
that's right.
But how do we actually get started?
Oh, that's a great question.
Oh, we just split the money 3 ways?
Not so fast. We need to talk about how to approach investing with that $500, how to choose the right brokerage account, and why diversification is about more than just picking different companies.
Okay, sounds like there's a lot to unpack there. So we've met our 3 dividend kings, Johnson & Johnson, Abbott Laboratories, and Coca-Cola.
Yep.
They all seem like solid companies, but how does someone with $500 actually start investing in them? I mean, aren't individual shares of these companies pretty expensive?
That's a great question, and that's where fractional shares come in.
Fractional shares.
Yeah.
I've heard that term thrown around, but to be honest, I'm not entirely sure what it means. Can you break it down for us?
Yeah, of course. So basically, it means you can buy a portion of a share
Okay.
instead of needing the whole thing.
Okay.
So let's say a single share of Johnson & Johnson is $150.
Okay.
You can buy 1/3 of a share with your $50 and still be entitled to a proportional piece of the dividend.
So even with $50, I can still own a slice of J&J and get those sweet, steady dividends. That's amazing. It really opens up investing to practically anyone.
It does.
Okay, so let's say I'm ready to buy my fractional shares. What should I look for in a brokerage account?
Yeah, so there are a few key things to consider.
Okay.
First, make sure the brokerage actually offers fractional shares. Not all of them do.
Okay, fractional shares are a must-have.
A must-have.
What else should I be comparing?
Fees are crucial, especially if you're starting with a smaller amount.
Right.
Some brokerages charge a flat fee per trade, while others take a percentage. So you want to factor that into your investment decisions.
Right, those fees can eat into your returns if you're not careful. Anything else I should keep in mind?
Yeah, think about user experience. You want a platform that's easy to navigate, provides clear information about your investments, and maybe even offers some helpful educational resources.
Makes sense. A user-friendly platform would definitely make things less intimidating for a new investor.
For sure.
Okay, so I've got my brokerage account all set up.
Right.
My $500 is ready to go. Do I just divide it equally between our 3 dividend kings?
Well, it's tempting to jump right in,
Okay.
but we need to talk about diversification.
Okay.
Even with $500, you can start building a well-rounded portfolio.
So it's not just about spreading my $500 between J&J, Abbott, and Coca-Cola?
Right. Think about it. We've got 2 healthcare giants and a beverage behemoth.
Right.
What happens if that entire sector takes a hit?
Okay, I see your point. Putting all my eggs in one basket, even if it's a healthcare basket, is probably not the smartest move.
Probably not.
So how do I diversify with a limited amount, like $500?
Well, it starts with research. You want to branch out into other sectors, maybe look into technology, financials, consumer goods.
So maybe a company like Apple or a well-established bank.
Exactly.
It feels overwhelming to choose when there are so many options.
I understand that there are resources out there to help. The Motley Fool is a good starting point, and there are plenty of other reputable financial websites and publications.
Okay.
Don't be afraid to dive in and do some exploring.
Okay, so research and diversify. But is dividend investing right for everyone?
That's a good question. It's a long-term strategy, not a get-rich-quick scheme. You need patience and a willingness to ride out market fluctuations. If you're after short-term gains, this might not be the best approach.
So if you're the type who panics when the market dips, dividend investing might not be your cup of tea.
Right, exactly. But if you're in it for the long haul and appreciate the idea of steady passive income, then Dividend Kings and even, those companies on the path to becoming Dividend Kings could be a great fit.
So let's say I've done my research,
Oh.
diversified my portfolio, and I'm ready to watch those dividends roll in.
Nice.
What else should I keep in mind as a dividend investor? Are there any best practices to follow?
Yeah, one of the best things you can do is reinvest your dividends. Instead of pocketing that cash, use it to buy more shares.
So use those dividends to buy more dividend-paying stocks. It sounds like a snowball effect.
It is.
The more you reinvest, the more you earn.
You got it. It's called compounding.
Yeah.
And over time, it can significantly boost your returns.
Compounding. It sounds almost magical.
It is pretty amazing.
Any other golden nuggets of wisdom for us?
Yeah, don't fall into the set it and forget it trap.
Okay.
While dividend investing is about the long game, you still need to stay informed about your investments, track their performance, stay updated on any news that could affect them, and be prepared to make adjustments as needed.
So stay engaged with my portfolio and not just assume everything will always go up and to the right.
Exactly.
Yeah.
Dividend investing can be a fantastic way to build wealth over time, but it's not entirely passive.
Okay.
It requires a bit of effort and attention.
That makes sense.
Mhm.
So we've covered choosing a brokerage account, diversifying our portfolio, and the power of compounding. What's next on our dividend deep dive?
So we've talked about why dividend investing is appealing in general, but let's zoom out a bit. How does the current economic climate, with inflation and the possibility of a recession, affect dividend investing? Are Dividend Kings still a good bet in uncertain times? That's what we'll explore in part 3.
We spent a lot of time, praising these dividend kings,
Yeah.
these companies that have reliably increased their dividends for at least 50 years.
At least.
But, let's be real. Things feel a bit shaky out there in the economy.
Yeah, for sure.
Does all this talk of inflation,
Right.
rising interest rates, a potential recession,
Mm-hmm.
does that change how we should think about dividend investing?
It's a valid concern.
Yeah.
I think, the economic landscape definitely influences investment decisions.
Right.
However, what's fascinating about Dividend Kings is that they often exhibit a certain resilience during economic downturns.
So while other parts of the market might be, in a free fall,
Yeah.
these companies are just sailing along,
Yeah.
paying those dividends like clockwork.
Yeah.
It sounds almost too good to be true.
Well, I would say they're entirely immune to economic pressures.
Right.
I mean, every company is affected in some way.
Mm-hmm.
But Dividend Kings, with their long history of steady performance, often have inherent qualities that help them navigate turbulent waters.
Okay, so spill the tea. What are these magical qualities that make them so resilient?
All right, so for one, they tend to have incredibly strong brand recognition
Okay.
and well-established positions in their markets.
Yeah.
Take Coca-Cola, for instance.
Right.
People all over the world know and love their products regardless of economic conditions.
You're right. A Coke craving doesn't just disappear when the economy takes a dip.
Exactly.
So brand loyalty is a powerful force. What else contributes to their stability?
Many Dividend Kings operate in sectors that are less sensitive to economic cycles.
Okay.
Healthcare is a prime example.
Makes sense.
People need medical care, regardless of whether the economy is booming or busting.
That explains why both Johnson & Johnson and Abbott,
Right.
our healthcare dividend kings, feel like such safe bets right now.
Yeah.
People aren't going to suddenly stop needing their medications or medical devices,
Yeah.
even if they're tightening their belts in other areas.
Exactly. And this inherent demand within certain sectors provides a cushion during economic downturns.
Right.
It's one of the reasons healthcare is often considered a defensive sector.
Interesting. So dividend kings?
Right.
with their powerful brands, established market presence, and often, non-cyclical businesses.
Right.
They offer sort of anchor of stability in a sea of market volatility.
Yeah.
But does that mean they're completely immune to those economic headwinds we talked about?
Well, immunity might be a strong word,
Okay.
but they're certainly better equipped to weather the storm.
Mm-hmm.
They typically don't experience the same dramatic price swings as, those high-growth companies.
Okay.
Or those operating in more cyclical industries.
Okay. So not invincible,
Right.
but definitely wearing some pretty heavy-duty armor.
Yeah.
But what about inflation?
Right.
Those rising prices have to be affecting these companies too, right?
Of course, inflation impacts every business,
Right.
including dividend kings. But what sets many of them apart is their pricing power.
Pricing power. Is that some kind of secret weapon?
Essentially, it's the ability to raise prices without significantly impacting demand.
Okay.
Think about it. If the price of a Coke goes up a few cents, are people going to stop buying it?
You've got a point.
Probably not.
And I imagine the same logic applies to, those essential healthcare products from J&J and Abbott. People need those products, and they're often willing to pay a little more, especially when it comes to a trusted brand.
Precisely. This pricing power helps dividend kings maintain their profitability, even when inflation is rearing its head. It's one of the key reasons they've been able to consistently increase those dividends for decades.
So we've got brand loyalty, stable sectors, and this pricing power thing. It's starting to feel like dividend kings are the superheroes of the investing world.
Right.
But even superheroes have their kryptonite, right?
Yeah.
What are some potential downsides to investing in these companies?
Well, one thing to consider is that dividend kings are usually large, well-established companies.
Right.
This can mean their growth potential might be more limited compared to smaller, faster-growing companies.
So they're more like the tortoise in the race.
Yeah.
Slow and steady rather than the hare that's darting all over the place.
That's a great analogy.
Yeah.
They're unlikely to experience those meteoric rises in value overnight, but they offer consistent, reliable growth and income over the long term.
Okay, so if you're looking to get rich quick, dividend kings might not be the right fit.
Right.
But for investors who prioritize stability and steady returns, they seem like a very solid option.
For sure.
Especially considering, all the uncertainty out there in the market.
Absolutely.
Yeah.
And remember, there's no single right way to approach investing. Dividend kings can be an incredibly valuable component of a diversified portfolio, bringing a balance of stability and income to the table.
That's a great point. So for our listener who's been diving deep into the world of dividend kings, what's the key takeaway from all of this? What's the most important thing to consider when thinking about adding these companies to their portfolio?
Here's the bottom line. Dividend kings are not a guaranteed path to riches, but they do offer a historically proven strategy for generating a consistent income stream and navigating the inevitable ups and downs of the market.
It's like they're the wise old sages of the stock market.
Yeah.
They've seen it all, weathered countless storms, and emerged even stronger. Maybe not the most exciting companies to brag about,
Right.
but they form the bedrock of a solid, dependable investment strategy.
Well said. And as we've discussed, their ability to withstand tough economic times makes them especially relevant in today's world.
Great insights. Thanks for joining us on this deep dive into the world of dividend kings. We hope you found this information helpful. And as always, be sure to do your own research before making any investment decisions.
Absolutely. Thanks for having me.